Hi, everyone, and welcome to today's webinar. My name is Anna, and I'm with the New Mexico Small Business Development Center. Today, we have Tommy Thompson joining us, who is a certified SCORE mentor, who specializes in business and corporate financial planning and business valuation. Tommy holds an MBA and is a retired CPA and will be presenting expert tips on buying and selling a business. Thanks so much for joining us. And without further ado, I'll hand it over to you, Tommy.
Thank you very much, Anna. I'm happy to be here today to talk to all you about a topic that I like a lot. I retired as managing director of a small boutique investment bank, and one of the things we did was merger and acquisitions advisories, not just serving as a broker intermediary, but doing more things than that, helping businesses plan strategically for purchases or sales of businesses, identifying targets for folks and other things. We're going to start off today and talk a little bit about me. How's that? I'm an analyst and a planner, a strategist, a writer, and a speaker. I've been that in most every position I've been in throughout my career. I've been a certified SCORE mentor since 2011, prior to which I developed about 40 years of business experience in industries ranging from manufacturing, technology, software, real estate, banking, hospitality, telecommunications, electric utilities. My late father-in-law used to say it was a shame I couldn't hold a job. In the course of that experience, I was a consulting firm manager for one of what were called the Big 8 CPA firms, now the Final Four. I was M&A director of a manufacturer of outdoor power equipment. If any of you have ever heard of the Troy-Bilt rototiller, that was the company I worked for several years. I was also chief financial officer of a software startup that I came in at the B round stage. And then I was chief operating officer for a tech manufacturer that I took public. As I said, I retired as managing director of a mid-market strategic consulting and investment banking firm. And all of that experience has got me here talking to you. So I hope you enjoy it as much as I enjoy talking about it. I want to acknowledge Daryl Arnn, who is the president of Arnn and Company in Albuquerque. He's the original author of many of the slides that we're going to talk about today. I've modified and revised them and gotten his permission to use them in this program. Arnn and Company is sort of a mid-market sell-side representative firm. Today, what we're going to do is we're going to touch on the training offerings and counseling assistance that is available through SBDC. We're going to talk about today's training objectives, and then we're going to talk about what we're going to talk about. Buying and selling a business. We'll talk about the process, concepts behind it, steps in the process. We'll take your questions and also talk a little bit about next steps going forward from today. Now, if you would, please mute your audio so that Fido or Rex the cat doesn't inadvertently get into the conversation. If you set your Zoom ratio to fit window, you will get a full screen display, which will give you the best view of the slides and the easiest way to read them. We'll be using the Q&A function to take questions. So if you have a question, write down the question and the slide title that was in view at the time that you had the question occur to you. We'll take them in the course of the presentation as we get a moment or two. We will try and answer them as close to the slide time as possible, so everybody in the presentation understands what's being asked about what was on the screen. So thank you for doing that. For training offering and counseling assistance from SBDC, you can visit the SBDC website. It's www.nmsbdc.org, and then click on the Workshop and Events button to look at upcoming training events being offered by SBDC. Also, SBDC offers no-cost business counseling and loan application assistance, which you can get by going to the website, again, nmsbdc.org, and looking around for the button that will get you to their in-person counseling efforts. So those are two things that you can get additionally, besides just what we're going to talk about today, through NMSBDC. Now, what are we out to do today? We're going to talk about raising awareness of the reasons for a deal. A lot of people say, oh, I want to buy a business, and they may or may not be honest about their motivations, both to themselves and to a potential buyer or seller for that business. We're going to introduce you to the business transaction process. We're going to describe the major elements of that process. We're going to provide some basic value concepts and a tool or two for how to estimate value um, in a private business sale. We have some negotiating tips for you in terms of getting to yes once you've gotten the information you need to make a decision and make an offer based on your estimate of value. We're going to provide some tips for getting her done, and that's getting the deal closed after you get to yes, because there's a lot of ground to cover between yes and okay, it's yours. And then finally, we're going to try and provide a little time for questions. Now, this has been cut down from a 3-hour program. So I'm going to talk fast, and if you'll turn up your listening speed, we'll get through it in the hour that we have together. So here we go. Now, we're going to talk about preparing for a deal, talk about searching for a deal, both buyers and sellers. We're going to talk about valuing a deal. We're going to talk about tax structure in deals, which is an extremely important part of the whole process, because the tax structure can result in a wildly different price depending on how the assets that are being bought or sold are treated for tax purposes. We'll talk a little bit about financing the purchase, negotiating the letter of intent. I consider letters of intent the vital part of beginning negotiation on a business deal. We're going to talk about conducting due diligence and what that means and what's involved. And we're going to talk about getting to the closing, where the lawyers actually go up and wipe their hands and say, okay, we're done. We're done. You own it. Go away. So all of that is we're going to get done in the next 53 minutes, excuse me. First of all, prepare. If you're a seller, you have to think about why you want to do this. If you're a buyer, you have to think about why do you want to do this. You have to be honest with yourself, because why you want to do something has a lot to do with how much it matters to you, and that translates into how much you wind up spending or how much you wind up asking for the business. Okay? Some common motivations on the part of a buyer. You're looking for, you want a job where you don't have a boss. That helps your independence. You're looking for to buy a business because you found health problems in working for someone else. You might be looking to, you might have a business, you might have your own business already, and you might be looking to grow the business you have by finding and make more money by finding synergies, areas where two can be as cheap as one, or two can do more revenue than one. Or you might be an owner of an existing business and looking to make a strategic purchase to go up or down your supply chain, to better vertically integrate yourself, to better horizontally integrate yourself with a greater geographic range of what you're doing. All of those are valid buyer motivations. For sellers, we have a lot of people in the baby boom, and I'm in the front third of the baby boom, so there's a lot of people younger than I am that are coming up on this. You own your own business and you're looking to retire, and your business may be your single biggest asset to convert to a retirement income of some sort. Some sellers are just burnt out. They've been doing this for a long time, or they've been doing this against increasing obstacles and increasing challenges, and they just want to get out because they're burnt. Age and health. You'd love to be doing this, but you're getting too old to do it. By the time you get to be 75 or 85 years old and you're still working, you have to be asking yourself, why am I doing this? And that applies at younger and younger ages as well. And also, health issues arise with age, and those are other, as well as those issues, as well as age. Those issues can be a motivation as well. And not just your own health as the owner. It could be the health of your spouse, your children, others that are dear to you, and needing to take time to be a caregiver for them is a valid reason for wanting to do a deal. And also, sellers who have no successors. The kids don't want any part of the business. There's nobody in the business that seems capable of making a success of it. And because you haven't done your job at developing management succession, or any of a number of other reasons you might not have a successor. But you do have to be honest about your motivations because they play into the emotions that help wind up affecting the pricing. How much you're willing to pay, how badly you want to do a deal affects how much you're willing to pay and how much you're willing to take as a buyer or a seller. Now, for sellers, this process ideally should start early. It should start 3 years before you're going to sell the business. All right. And the reason for that is to groom the business, to make it look as good as possible, absolutely tip top before you put it on the market. So you're going to manage the business to develop maximum cash flow for those 3 years. You're going to emphasize profitability in what you're doing, and you're going to minimize anything that erodes that profitability. Typically, you're going to reduce capital expenditures in the 3 years before you sell the business, unless you have something that absolutely is critical to the business operation, to the business flow. Because by reducing capital expenditures, you're increasing your actual free cash flow. All right. Because someone who comes in and sees that you spend $1 million on a capital expenditure in the year before you're selling it, they're going to wonder, well, how much more capital expenditure am I going to have to spend going forward? All right. You want to try and improve your credit standing as much as you can for the business, because remember, this is the business we're talking about, and the business has a credit standing and a reputation, and you're going to want to make sure that when a seller starts looking into things in the course of their due diligence, that they find that you've conducted your business in a completely competent and ethical manner. All right. And improving your credit standing is just part of that looking good. Now, one of the things you do in that 3 years is you continue prospecting for new customers. Don't stop marketing in order to save money to make the cash flows look better. All right. Because when you do that, you're going to start seeing your customer base erode, and it may affect your actual top line. So do continue to spend money on marketing. Some other things that sellers need to do are to do your own due diligence on your business. In other words, make sure that you don't have any bad reporting out there, that you don't have any open liens on anything, that you have taken care of your tax obligations in a fully integrated, fully ethical manner. You need to make sure you work on maintaining exceptional customer relations so people will say good things about you when somebody starts talking to them, and they will. You're going to want to work to make sure your workforce stays motivated, stays trained, stays willing to continue keeping the business going. You're not going to want to tell them about a sale process. We don't want to do that, but you do want to make sure that you're managing for maximum workforce satisfaction and motivation. You want to make sure your capital equipment and your systems, your operating production systems, are in good working order. They don't need to be new, but they do need to be well maintained and operating up to their potential. Now, if you haven't done this before, you're going to want your CPA to start preparing an annual financial statement for you. And in the year you sell, you're going to want them to start preparing quarterly financial statements for you. The reason for that is that CPA prepared financial statements offer you a level playing field in that everybody knows how to read. Most everybody who's interested in buying a business knows how to read a financial statement and knows that the notes are important. Your CPA will put together these financial statements in the form that generally accepted accounting principles require so that they are intelligible to the people that you're going to show them to in the course of this process. You're going to want to invest in income taxes. And what do I mean? What I mean by that is you're going to want to be as clean as possible and take as little controversial risk positions in your taxes as you can. You'll work with your tax preparer, usually your CPA, to be sure that you are being as straightforward as possible within the tax laws. Don't overpay your taxes. I'm not advocating that, but I am saying that you should be punctilious about doing exactly what the letter of the law requires. And that includes not just your income taxes, but also any other tax authorities that you happen to be working with. If you have any litigation claims, either existing filed litigation or threatened litigation that you know about, all right? Somebody says, well, I'm going to sue you, and then they go away, but you haven't seen a suit yet. You're going to want to try and clear that stuff up. You're going to want to negotiate a settlement for any threatened litigation by finding out what the angry person is after, and coming to a deal with them. Or you're going to want to get your attorney to settle, to the extent possible, any outstanding or existing litigation. Buyers rather are turned off by litigation. And then finally, you're going to want to make sure that you can get, sorry, back, that you've got all of your contracts in order. Anybody with whom you're doing business, anybody with whom you are working with some sort of contractual event, you want to make sure that you're all up to spec with them. Now, both buyers and sellers have to put together what I call a marketing package. In the seller's case, it's a formal information memorandum. It's a memorandum that tells the business story and provides a financial overview going back 3 to 5 years. It presents the business in its best light without misrepresenting any facts, of course, but telling the business in its own light. And those information memoranda can look as big as a business plan. They could be 10, 20, 30, 40 pages. Okay, I've written them, and they get that big without too much trouble, because you want to make sure you address all aspects of the business and provide all the information that a buyer needs in order to develop a preliminary offer for the business. All right. So that's telling the business story on the seller's part. From the buyer's standpoint, you've got to sell yourself to the seller as a qualified buyer. And to do that, you're going to need to have a resume of your career and what you've done and why that qualifies you to be the owner executive of the business you're interested in. You're going to want to provide a personal financial statement that says you have the capacity to do this deal in some form. You're going to want to provide a credit report that provides information about what other businesses think of your dealings with them. And you may even want to put together a brief operating plan. If I bought your business, this is how I would operate it. All right. And that operating plan can tell a seller what and how much the buyer values certain areas of the business, including, for example, the workforce. A lot of sellers, this is for you buyers out there, a lot of sellers want to see that their workforce is taken care of, that it's retained for the most part, that it continues to provide the jobs that the seller has provided for those folks for the last 5, 10, 20, 30, 50 years. All right. Now, once you've gotten that taken care of, you then want to assemble your records. And this is mostly for sellers. You want to put together your financial statements, your tax returns, your organizational documents like articles of incorporation, bylaws, legal documents about the business. You're going to want to put together job descriptions for your key staff members. These are the people that you rely on to make the business work. You're going to want to have available copies of any and all contracts, leases, any and all litigation that's filed or still in process. You're going to want to put together your corporate books and records, and that's your corporate minute books and stock register books and so forth. And you're also going to want to put together a little bit of information about your major customers. If you're like most small businesses who are providing services to business, a business to business kind of business, you'll have 4 or 5 key customers that might make up 50 or 60% or more of your business activity. You're going to want to be able to tell a buyer about those folks, who the key people are, what they do, how long you've dealt with them, and so forth. So that's going to be necessary information at the sort of intermediate stage, I call it. Now, Also, as you do this, you're going to want to pick your advisors. And I tell everybody to think of this as a team sport. This requires a team. If you're a buyer, first of all, you need a lawyer to help you draft your offer in legal form. You need an accountant or a CPA to help you with the valuation details of the business and the tax aspects of what you're going to encounter. You may or may not want a broker intermediary, and I'll talk about that in a minute. But you're also going to want to have a financing source available that you can, in effect, sell to the seller. That you can convince the seller that you have the capacity to put the money on the table and the loans in place that will support whatever deal you come to. For sellers, you also need a lawyer. He's going to be the person who protects your interests in a deal. You need your accountant and CPA to advise you on what the tax consequences of a transaction are going to be. And again, they can vary wildly based on how the deal is set up. Also, and I'll talk about this more in a minute, a broker intermediary is one of your team members, possibly, or maybe not. You might want to go do this by yourself. And then finally, as a seller, you're going to want a financial planner on the team to provide you the means of properly structuring the investment of the proceeds, let's call it that, and how you're going to plan to draw on those proceeds to fund your future after you're no longer drawing a salary or owner draw from the business. So those are the people you want to keep in mind. This is a team sport. Now, you want to go out and search. And here is where a broker intermediary becomes a good idea for a buyer and a good idea for a seller. And the reason is that it can maintain, using a broker or intermediary, can maintain confidentiality. You can hide your identity while you're looking around because word gets around. In your business community, word will get around that you want to sell. If it's you out there looking for buyers, or if it's a buyer out there looking for sellers, word will get around. And if you're in a business already that's looking to buy to expand, that may have pluses and minuses. I'm not going to get into that in detail here today because of time limitations. But when you're searching, you can go to a broker intermediary, a business broker, or an M&A intermediary consultant. You can go to trade associations. Their publications often have classified listings of businesses for sale in their association area. You can go look to accountants and attorneys for referrals. If you develop relations with some of those organizations around town, an accounting firm or a law firm, they may be aware of clients of theirs that are looking to buy or sell. Certain newspapers will also have business opportunity classified listings. I know that Wednesday's Wall Street Journal often has in one of its sections a business marketplace where small ads get placed to pique people's interest about particular kinds of businesses. And those are almost always what I call blind ads. It might say Southwest U.S. manufacturing firm for sale, $1 billion revenue, and here's an email address. That's all it might say. But you'll get, for something with like the Wall Street Journal, which has, hundreds of thousands, if not millions of people reading it every day, you'll get responses to those kinds of ads. You can look on the internet and just Google businesses for sale or businesses to buy and see what comes up. And then finally, your competitors as a business owner, if you're a seller, your competitors are often the most likely buyer, but you have to treat them carefully. And we'll talk about reasons for that in a little while. Some internet sites that you can go to, and by the way, you're all going to get a copy of this slide package afterwards, so you don't have to write these down right now. Brokerage companies in general, IBBA, International Business Brokerage Association.org, MASource.org, bizbuysell.com, firstlist.com, dealstream.com. There are others, and you can find them with a quick Google search. These are just a few. And then finally, let's talk a little bit about confidentiality. A seller's major concerns are that, quote, my competitors are going to find out and steal my business. Or this buyer that's asking for information is going to steal my business. Okay. you will find is as you decide you're going to sell a business, that word gets around. It depends on who you talk to and how you act and react and what kind of vibes you give off. Your workforce will pick up those vibes. You can guard against some of these concerns by using confidentiality agreements and uh, uh, information exchange agreements that limit the ability of a competitor or a potential buyer to use the business information you're going to exchange with them. And those confidentiality agreements are developed by lawyers. You should talk to the lawyer on your team about what you want in yours and how much you want in yours. But remember, at the outset, at the early stages of the game, you don't want a real tight confidentiality agreement, because you want to be able to show basic information about your business to a wide variety of people. And that information about your business doesn't need to include trade secrets or anything. It just needs to be a good, straightforward recitation of what your business is and how it works, along with a financial overview. And in those cases, a simple non-disclosure. Hi, I'm giving you this information so you can evaluate a potential transaction. You're not going to use it for anything else. And if I ask, you're going to give it back to me if you decide not to proceed. That's very simple kind of non-disclosure agreement. Everybody's used to those. Now, going it alone versus using an intermediary. Both buyers and sellers. How many businesses do you think you're going to buy or sell in your lifetime? How much experience do you already have in buying or selling a business? Asking yourself and answering those questions honestly gives you some indication of whether or not you ought to be using an intermediary. Okay? For both buyers and sellers, an intermediary offers confidentiality. No names need to be disclosed until you get to a further point in the process where you're prepared to proceed. Okay? An intermediary has experience having done dozens and dozens, maybe hundreds of deals in their career. They know how deals work. They can look at a deal and offer consultation and advice on preparing to do a deal and on the process of getting the deal done. They have resources and networks to help you find buyers and sellers. They have experience in negotiation. They have experience in understanding motivations and structuring a deal to satisfy the motivations of the buyers and the sellers. They know market conditions. They've been doing deals throughout the period of time. You just showed up and said, I want to buy a business or I want to sell my business. Okay? They know how the market is moving up or down. They can buy you time, because an intermediary can always say to the other side of a transaction, well, let me check with my client and I'll come back to you. And that buys time. Intermediaries are also good at diffusing emotions. Both buyers and sellers are going to be emotional about it. If it's a seller, well, it's your baby. You built it. You've been nurturing it for dozens, maybe 10 or 20 or 30 years. And the emotion of parting with that is a very strong one, and it leads some sellers to want to either price too high or insist on unrealistic terms with respect to workforces and locations and customers and things. So an intermediary can help strip the emotion off of getting a deal done. For both buyers and sellers, the intermediary has experience in looking at a business and offering their opinion on what businesses like this should sell for. Okay. Now, this isn't a professional valuation of the business, and we'll talk about those in a minute, but this is the intermediary's experience and feel for transactions and buyers and sellers in suggesting what a reasonable deal price might be for any specific situation. For buyers, intermediaries often know who has an appetite for the financing of business purchases and sales. Not every bank wants to finance business purchases or provide, let me call it, investment resources for a seller's proceeds. Okay. Intermediaries can help to do that. Intermediaries also help with competition, principally, and we circle back to the top here, in the confidentiality aspect of things. Now let's talk about value just for a moment. I'm going to spend a very short amount of time on this because we're well into the program here. There are a number of reasons for valuing a business. The one we're talking about today is the top one, mergers and acquisitions. Other reasons include partnerships, taking in partners and valuing the partnership at the date of taking a partner in, breaking up with a partner, valuing the business at the date of the breakup, startup financing and planning, divorce, estate tax, insurance and estate planning are all reasons for valuation. And I left that last line in there because you can write in your own reason if you have one. And there are other reasons besides the ones we put in here. It's axiomatic that buyers pay for the past because buyers structure their financing and their offer based on past performance. But they're really buying the future of the business because it's the future cash flows they're buying. Sellers explain the past with what they've done, but they're selling the future of the business because they're expecting the business to continue into the future. I've boiled that down to say it's worth to you what they've made of it. It's worth to them what you can make of it. And therefore, the price that you negotiate is going to lie somewhere between those 2 points. Now, here's our benchmark. The fair market value of a business is the amount at which a property would change hands between a willing seller and a willing buyer. Neither of them has to do a deal. Neither's acting under compulsion. That's what that means. And both have reasonable knowledge of all the relevant facts. Now, how often does that happen in real life? It doesn't, because everybody has differing compulsions, differing purposes, differing objectives, differing goals, okay? And neither side ever has complete reasonable knowledge of the relevant facts. So, having proven that our fair market value benchmark is a chimera at best, it is the tool that business valuation professionals use to analyze a business and develop an estimate of what its value is. The price that you actually negotiate for a business might be higher or lower than the fair market value. That's because a strategic buyer could know something about the business in their hands that it makes it much more valuable to them than it is to the seller currently. Or conversely, the seller may know things negatively about the business that make it less valuable than the fair market value. You estimate the value. Determine is a word I don't like to use. I'll change it the next time we do this. And you negotiate the price. Value and price are two different things. The most important considerations, if you're going to look at determining a fair market value as a benchmark for negotiation, are the operating cash flows of the target business, the value of any tangible and intangible assets in addition to the ones producing the operating cash flows. Okay? It's not cash flows value plus assets. The assets that are producing those cash flows are part of that overall cash flow value. But there may be other assets in the business that the seller wants to get rid of that aren't part of the business operation but do have value. For example, they have a factory and a yard that takes up 3 acres, but it sits on a 75-acre property in a good commercial location. Okay, that's one aspect of it. The third most important one is the buyer's required return on investment. It's what the buyer wants to get out of the deal that makes an important contribution to the buyer's determination of fair market value. Now, as a valuation professional, what we do is we develop a benchmark ROI. We develop that benchmark by looking at equity returns in the marketplace and what debt costs are in the marketplace and what typical debt to equity structures are prevalent in that industry. All right. There's other ways to determine FMV, and those are the comparable sales method, replacement value method, also called the cost method. They rely on what other businesses in similar situations have sold for, or what it would cost you to build this business from scratch to where it is. And that typically has a big intangible component that's hard to estimate because It's the value of goodwill in the business. All right. It's what customers think of the business. It's the years in business. It's the reputation of the business. All of that is part of that cost to replace, but it's hard to estimate. You're also going to want to look at the market segment that the business is in, the business's reputation, whether it has any contractual territory rights. And also you have to look at economic conditions in the business's operating area, both currently and what's forecast for the next year to 3 to 5. All right. All those go into a business valuation analyst's consideration when they're coming up with their independent estimate of what a business is worth. Now, we're going to talk a little bit about income, and there's several ways to talk about income. First of all, there's net income according to the accountants as to how the accountants determine net income. Then there's something called seller's discretionary cash flow, or SDCF, and that is the cash available to the seller exclusive of what's needed in the business that they can do what they want with. They could spend it on capital equipment to expand. They could take it out and spend it on an airplane to go fly around in. They could pay themselves. They could buy groceries with it. It's the seller's discretionary cash flow. We'll look at an example of this in a minute. And then there's a concept of something called earnings before interest, taxes, depreciation, and amortization, or EBITDA. That's a proxy for operating cash flow, and that's a basis, when you apply an ROI to it, for determining value. Here's an example. If net income is $100,000 after all those things, then before those things, we got interest expense of 20, income tax 25, depreciation of 10, amortization of 5. We might have an EBITDA number of $160,000. That's EBITDA. Going beyond that, if we take out the owner's salary, the owner's health insurance, their personal automobile, and the airplane they bought last year to fly around in, we might have a considerably larger SDCF. Now, as buyers, you have to watch out for this, because what you want to make sure is that the cash flows you're calculating or estimating your value on do include a salary typical of the industry and business for a manager. Now, that's going to be you, and you want to make sure that you buy the business based on its cash flow with that manager's salary taken out, with that manager's salary included in the cash flow. Okay? Otherwise, you're buying yourself a job. And I advise people not to do that. Now, sellers, every business broker you ever talk to is going to tell you to add back your salary to the cash flow to make it look better to a buyer. Buyers know this, sellers know this, intermediaries know this. Everybody plays the game. That's a negotiating point in there. But non-operating business assets, like a perk, like a personal auto, or a perk like an airplane or a boat. I've seen a number of different kinds of things. The vacation house at the lake. Those and the cash flows related to them are all appropriate to add back to the seller's discretionary cash flow. Now, the basic valuation formula is that the value equals earnings times some multiple. Okay? In the business valuation process, we determine what that earnings base is and how it's defined. We evaluate the business risk in order to arrive at a multiple, right? And as we just talked about, there's several different ways to define earnings. You've got net income on the books, you've got EBITDA, you've got SDCF, okay? And you arrive at a multiple. Lower multiples reflect higher business risks, lower growth or synergy potential, or industries where debt capital is not readily available, where you're going to have to put more equity into the deal, okay? A lower multiple implies a higher rate of return, okay? If I look at a multiple of 2, okay, now I can go 1 over 2, or 0.5, convert that to percentages, and it's a 50% ROI goal. A multiple of 3, similarly, 1 over 3, 30.33, 33%, that's a 33% ROI. That's lower, all right? And as you get up there, you find multiples of 4 equate to a 25% ROI. Small businesses that are not diversified and have limited economic reach, limited geographic reach, are always more risky than businesses with broader reach, with a greater market, a larger market, and a greater potential for penetration or a greater potential for synergy with another business like it. Okay. Higher multiples. Those higher multiples relate to lower business risk. In the real estate business, a return of 12 or 14% on equity is considered pretty good. All right. That translates to like, oh, say a multiple of 8 times earnings, which seems like a lot, right? But it reflects the generally lower business risk if you have a higher growth or synergy potential by selling to a business in the same field. That synergy may impel the buyer to offer a higher price because they know they can make more than that by putting two businesses together and saving on things like, oh, the accounting staff or the sales staff or things like that, because now the sales staff has more stuff they can handle. Also, in industries where debt capital is readily available, like, say, real estate, a higher multiple may be more appropriate because you can have a higher amount of low-cost debt. Debt costs less than equity. You can have a higher amount of debt in your capital structure, and that means that you can then afford to pay more money for the property. There are rules of thumb out there. You can find industry averages that are based on percentages of gross, multiples of discretionary cash flow, industry-specific rules of thumb, but all of them can be misleading and inaccurate because they're being applied as a stereotype across the entire industry, not with respect to the particular situation of an individual business. Valuation specialists are out there. I was one before I retired. They would get called in a specific situation to advise on the value if a more detailed value opinion was needed. They provide you an independent, objective opinion of the fair market value. They are credentialed professionals. There are several different ones. Some of them are listed there. Valuation professionals can be expensive. The scope of work that you sign them up for is critical, and you may need cooperation from the target in order to get them the information they need to do their work in a full scope fashion. So just keep that in mind. Your intermediary is a good source for the basics. If it needs something more detailed or for a more supportable discussion of why you're negotiating for that price, a valuation professional can be useful. Now, the reasonable test, the sniff test of this is to ask yourself, will the operating cash flows satisfy the claim holders? Will it satisfy the lender with some left over? Will it satisfy Uncle Sam for income taxes and some left over? Will it satisfy company working capital and capital expenditure requirements? If a company is growing, it needs to grow its working capital too. And it may need more capital expenditures to expand its capacity to serve customers. Will there be enough cash flow to support that and some left over? And finally, will there be enough to support the equity investor's return requirement? All right. Ideally, there'll be a little left over, but you got to at least satisfy these claim holders on those cash flows. And that's the reasonableness test for valuation. Will the cash flow support what you're going to do with the cash? Now, the actual selling price of the business is ultimately going to be a result of give and take, negotiations between the buyer and the seller. And that gets you the concepts of fair market value, fair deal versus best deal. Okay? But that negotiation is what is going to bring you to the deal. And it's not just about price, because owners and buyers have other objectives besides financial ones that may creep into the terms of the deal. The seller may be willing to give up some of the price if the buyer commits to keeping the workforce intact for a period of time. Okay? That's one of the commonest ones. Now, tax structuring. The big dichotomy in these deals is how you structure the purchase and sale transaction and how those different structures are taxed. The two big, the dichotomy is between stock sales, that's sales of the registered capital stock of the corporation, versus asset sales, that's the physical, tangible, and intangible assets of the company. All right. And selling stock results in capital gains usually for the seller. Selling assets results in ordinary income for the seller, which means that the seller may have to pay more taxes on an asset sale. Depreciation amortization periods get involved here. The buyer gets tax advantages by buying assets. There's also deferred recognition of gains available to the seller if there's an installment component to the sale, and there's an interest income or expense component to the sale or the purchase. That all means that it's another reason to have your CPA on the team to advise you about what the consequences of these choices are, so that you're aware of them and you can adjust your negotiations correctly. There's several different entities you can use. Most people these days use LLCs in some form or another. Even Chrysler Corporation is an LLC these days. So keep that in mind. Your lawyer can advise you on the pros and cons of each of them. Then, financing the deal. Typical financing options in a deal are conventional bank financing. There could be SBA guaranteed loans, sort of capping that conventional bank financing. Usually the seller will take back a subordinated note for some period of time. That will provide part of the financing. The buyer's personal savings, equity in their home, investments from family or loans from family and friends and fools. And also retirement plans are available and might be able to participate by purchasing some of the deal. I don't recommend that. Okay, if you have a retirement plan and you've rolled over a 401k or something from a previous job, consider that job's contributions to your retirement, and try to avoid using retirement plan funds for any form of a deal. Okay, there are ways to do it. You have to be extremely careful as to whether your retirement plan custodian will let you do that, whether their rules let you do that, what the federal rules are, so that you don't find yourself with being under 59 and a half and needing to, for example, withdraw from a retirement plan, which costs you not only the income taxes on the withdrawal, but an extra 10% as well. So keep that in mind. Conventional bank loans are typically asset-based. They will finance equipment, inventory, receivables, any of the physical assets. They typically are issued for short to medium terms. They may have higher down payments associated with them. Cash flow lending is based on the EBITDA. Banks tend not to like to do this, but they might package it in with something. Okay. There are Ebt adjustments, add backs that make sense in the context of a deal. Your accountant and your attorney can talk about these with you. Your broker intermediary will tell you which ones are common in your industry. Then the buyer and the seller have some information to exchange. This is a list of the kinds of things that would be common in an initial in negotiation, before an initial negotiation gets underway. Also, part of this information exchange, after the preliminary information is exchanged that enables the buyer to complete a preliminary LOI, those things are the business deal. They pertain to the business deal, not the legal aspects of things and the protection of buyers and sellers' interests in a definitive purchase agreement. Now, anything else that's necessary comes along as the deal progresses. Once you get a negotiation that says yes, then you proceed from there with what's known as due diligence, and we'll talk a little bit about that. I always advise clients to use a letter of intent. A letter of intent sets forth the business deal, okay? It sets aside emotional attachment. It sets aside market advice and experience. It uses that to get to an offer. In negotiating a letter of intent, you can use your lawyer if you want, but typically it should be between you and the other side. If you're a buyer, it's with your seller. If you're a seller, it's with your buyer. Keep the lawyers and the brokers out of it. They've already advised you going into this. And when you come to an understanding, the letter of intent codifies that understanding. It sets it down. It says, this is my offer. This is the deal structure. Here's the price and terms. Now, these are deal structure and price and terms are subject to negotiation. They're also a deal structure. They're not, a letter of intent is not a binding agreement. Okay, it's an expression of what we want to do. There are two parts of a letter of intent that are binding, however. The first is what's called a no shop provision, and that says that the seller will not entertain any other offers for a period of time from the date of the LOI. And the reason that is in there is to allow the buyer the time to finalize their financing, conduct due diligence. They're going to spend money on lawyers and accountants in doing due diligence, and that is going to have a cost. And so a buyer can reasonably expect that a seller isn't going to shop the company around, isn't going to advertise. It's going to take it off the market for that period of time and turn down any other interests and offers. The other thing that's a key negotiated item in a letter of intent is the confidentiality agreement. And the two sides agree to confidentiality. They agree that what they're exchanging is being used only for the purpose of evaluating a deal and not for stealing the person's business or opening a competing business. And that provision survives the letter of intent. Again, lawyers write these things. Any other negotiated items that are important to the buyer and seller should be reflected in the letter of intent. It's the business deal. Then that structure is in the letter of intent. You go on to do due diligence, and it works both ways. The seller does due diligence on the buyer does due diligence on the seller. If you're well prepared to begin with, there's less time necessary for this. All you want to verify as a seller is the buyer's capacity to close the deal. The buyer, for his part, wants to verify that the seller has legal title and right to sell what it is he's advertising for sale. Buyer due diligence is legal. Your lawyer is important for this. It's operational. It's important to you as the buyer to do this. And it's financial. Your CPA can help you with all the items that are here. All right. And there's a multitude of tasks that get done. I did a deal once where I wrote a 33-page task list of what had to get done in due diligence before we could get to closing. In non-financial due diligence, things not money, it's the business's reputation and market position. You've got to verify that. You've got to have agreements in place to keep key employees aboard. And that means you may have to approach them and make offers to them. You have to verify that customer or vendor relationships or even franchise agreements are transferable, that the franchisor, if it's a franchise, is likely to allow this to happen. Okay. Can you do or learn to do what the business does, and can you improve the business are two questions to ask yourself at the start and at the due diligence point. Okay? They're very important. You have to have faith that you can improve the business and that you can serve as manager for what the business does. Closing, we get to closing because we've got to do the deal. We've got to sign on the dotted line. We got to give them the check, and they've got to give us all the title to the assets. All right. You're going to draft and finalize a purchase and sale agreement. This includes all the legal protections that your lawyer is going to do to protect your interests. You choose the acquisition entity and you create it. You set up its books. You get employer identification numbers, gross receipts tax numbers, workers' comp numbers, insurances. That's all for places where you buy the assets. If you buy the stock, that already exists. You got to set up banking relationships, insurance, payroll services. You do a final inventory count if inventory is involved, and evaluation of that inventory for closing. That's a typical adjustment at closing for the price. You also check contract conditions. Make sure the conditions preceding to closing, it's called, are fulfilled on both sides. You may have an escrow agent involved, and there are just details and details and details. If stock sale is involved, there's stock certificates and stock transfers. If there's assets for sale, it's physical asset bills of sale, lease assignments, personal guarantees of the buyer for the financing, checks from lenders, and it goes on and on and on and on. Post-closing, after closing, there's typically a working capital true-up adjustment for what the working capital actually was at the day you actually closed. Okay, and that may be in between. Financial statement periods, in between the closing at the end of 1 month and the next. Any training that's going to be provided by the seller to the buyer, any integration of buyer's operations with seller's operations happens. You collect and pay the seller financing. Seller collects, the buyer pays seller financing. You calculate earnouts and pay them, and you monitor the deal. Is it proceeding according to the way it was envisioned? You know, and you go forth and implement your operating plan for the business. That's what's very important. Now, I haven't seen any questions pop up, but if you've had any questions, as I've talked very quickly for the last 57 minutes, please write them down for me now. That would be great. I'll look in the chat. I've got 4 things in the chat. Anna is thanking you for your attendance and notes that you'll receive a copy of the webinar slides on a follow-up. And there's also a post survey to better tailor these webinars. And a couple of other notes there. I particularly appreciate your feedback in the post webinar survey, because this helps me to understand where to emphasize topics more or where to gloss over topics, so I have more time for those more emphasis topics. I really appreciate it. And feedback helps me understand how well we're doing here. Don't all ask questions at once. Yes, we do have a question. How to find an intermediary, Thomas asks, and I'll answer that here. There's several ways. In your own geographic area, look up whatever yellow pages that you have. It's an old term, I know. Or you Google business brokers or mergers and acquisitions intermediary firms, and those will pop up. And then you append Albuquerque to that. Okay, or whatever geographic area you're looking in. It could be Denver, Phoenix, LA. If you're talking about a business that has a national scope or a national scale, you might look nationally for a firm that operates in the same general industry or the same general size of business. Okay, there are small business intermediaries. They're generally called business brokers. There are mergers and acquisitions advisory firms that describe themselves either as mid-market or national or international or large scale. They may use words like that, but you want to try and fit the intermediary that you're looking for to the size of the business that's involved, the size of the deal that's involved. The firm I retired from, which is called Schwartz Hessland Group, which is in Latham, New York, near Albany, New York, 2,200 miles from here, was a mid-market strategic and M&A advisor. What that meant was we would often get involved with a client before there was any deal in prospect, and we would have been providing them with strategic growth advice for some period of time. We might have provided a valuation engagement for them in the first place because they wanted to find out what they could be worth if they were to contemplate a transaction, or what they could be worth if they were going to restructure their ownership and sell some of the company to a new partner, those kinds of things. But that's the best way to do it, is, Business Brokers Albany. Well, every business is hard to sell. it can take 6 months to a year to sell, sometimes even longer. And if you start preparing 3 years in advance, that sale process can be a little bit compressed. But again, here, as Thomas says, somebody who understands online marketing. Well, you're looking for a buyer who understands online marketing, okay? And you put that into the information that you use to generate the initial interest from potential buyers. You would say, you know, online marketing business for sale, volume in X range, location in X range, national reach, respond to, and give them an email address. By the way, when you do that email address, you should set up a brand new, only for that purpose email address in Gmail, and have all the initial inquiries come to that email. All right. Don't use your personal email, because you want to keep all of that separate from other email that you might have. So that's a consideration. And you can say, you know, great opportunity for online marketer. And that qualifies, that pre-qualifies the people that are going to respond to you, because they will know that this is an online business. All right. So get that one done. That one done. Anybody have any other questions? Yes, we have one more. Okay, so thank you from Thomas. Appreciate that. If there are no more questions, first of all, let me say this. If questions occur to you as you review the slide materials after this webinar is over, please send them to Anna at SBDC, and she'll pass them along to me, and I'll get the question answered and get back to you on that. Let me make that commitment to you today. We've talked about an awful lot. Okay, and Anna is just putting that up in the chat. Okay. We've talked about an awful lot. We've talked very quickly. This is a topic that I've both taught a 4-hour seminar on, I've taught a 3-hour program on it, and I've taught it in a 1-hour webinar a couple of times. There's a lot to cover. It's a lot to come at you at once. As you consider and process what we've talked about today, again, as you have questions, please ask them and we'll get you an answer. If there aren't any other direct questions right now, and we seem to have one here, are you for hire? Unfortunately, I'm not. As a SCORE certified member, we're not permitted to be compensated for hire by clients or folks, and SBDC has the same requirement. So the folks who are for hire, you can find with a Google search, and I wish you well and success in that process. But I'm flattered that you would consider me, but thank you, I can't do it. If there aren't any other questions, I will say thank you. I appreciate your time today. I know we're a little bit over right now. Very quickly, SBDC has asked me to include this slide for you. I'm not going to say anything about it. It's resources during the pandemic. If there's more information, further training, business counseling, assistance that you're looking for, nmsbdc.org is the website again. You'll get a survey for email after this presentation is over. In terms of next steps, and I'm just going to say something about next steps, those of you who are looking to sell, start preparing now. Those of you who are looking to buy, start looking now. With that, I will say thank you again and wish you all a very good day. Thank you for joining us, and I appreciate your time, and I hope you enjoyed what we had to say. Have a great day, everyone.
So much, Tommy, for your time and expertise. And thank you, everyone, for your attendance, and have a wonderful afternoon.